Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our EIA show, and we're going to go through our normal breakdown of a broader overview of what's happening in the U.S. and a little bit about what's happening on global storage. Then we're going to go deeper into U.S. What are some of the demand drivers? What do we see going forward? And then in segment 3, we're going to do an OPEC update as they're meeting tomorrow. And then we're going to look at global flows and how things are starting to change now that we're starting to get some crudes moving hands, changing hands, moving around a bit more. So we want to go through where is it going, what price was it purchased at, and where do we see prices going from here, especially when we look at the physical side. So kicking off, when we look at what is happening in the EIA data, I mean, it was fairly mixed. There wasn't too much to say one way or the other. Crude is obviously selling off a bit, and it's more because when you look at the charts, because charts obviously matter just as much as anything else, it was starting to get a bit bearish. People are taking some risk off ahead of OPEC. There's been an increasing call from both India, the U.S., to have them increase flows. But when you look at the actual barrels right now, especially as we talk about West Africa, West Africa is having trouble clearing a reduced amount, and we'll talk about that more in segment 3. So it's going to be difficult to see them do, I think, anything more than just the 400,000 barrels, which again it's not a terrible thing. It's just that's, I think, the very stable thing that we're going to continue to see, and based on that, we should probably see a bit of an increase in pricing, or I should say futures pricing, because I think people are expecting a 600,000 barrel a day increase. But again, I'm not sure that that's really going to be the case. Overall, when we look at crude, it was fairly in line with normal. The pace was a little bit slower, which is a positive if you're looking at this from a bullish or bearish side. Then when you look at gasoline was very normal in terms of the trend down. Distillate had a sizable increase versus expectations, but again, we're at such a low point that we expect to see that, and this is what we've been talking about the last couple of weeks, was that we expected to see a disty build, and that was a bigger driver. And then when we look at imports, fairly flat. We're still not seeing a big increase in PADD 3, though floating storage is starting to creep higher. So again, we expect to see that increase this week into next week when we're looking at PADD 3. So again, there was something for everyone. Diesel demand, when we look at the demand side, diesel demand came down again. We were expecting a little bit of an increase. And then, as we said last week, gasoline and jet fuel had kind of that makeup number, and we expect that to come back down. But we'll go through that more in segment 2. And then obviously we're getting close to Thanksgiving, so we're going to start talking about what are people saying are their plans for Thanksgiving, and what does that look like in terms of, versus not only just pre-COVID, but also how different is this going to be, and what are going to be some of the adjustments. So then when we look at total oil and product stocks, you can see that we're just above that 2017, 2019 average range. And this is when you look at total oil and total products globally. So you can see that we increased the surplus to plus almost 20 million barrels. I know that there's been some commentary from some satellite individuals. I think it's Kairos, that are saying that there was a big draw last week, and they're saying that 40% of that comes from India. So when you look at these numbers, this is mostly OECD and essentially what can be tracked, both when you look at east of Suez, west of Suez. So what they're looking at is something that's falling outside of this. And one of the things that we've been talking about is that India has seen a big increase in some of their throughput on the refining side, but they've even though they've started increasing their purchases, it's still below what expectations were. So it could just very well be a balancing act in terms of bringing down some of those oil and storage and trying to kind of slow steam some of this to try to manage price, just given that India's, one of their biggest costs is the import of oil. So I think there's a little bit of that, of trying to manage and take some of the lower price stuff that's in storage and marry it with some of the higher, well, not some higher, but much higher prices coming in off the water. And they've been able to get some discounts specifically from the Middle East, which helps alleviate some of that pressure. And then they've gotten some discounts from the West Africa. But again, these are some of the things that we'll be watching and talking about more in segment 3. So then when you look at that total oil product stockpiles, that this still remains low, which is again why if I look at this, I'd want to be, short oil, long diesel, or the heating oil crack. So again, there's some adjustments that we continue to see when we're looking at what is happening. And this is factoring in land and floating, because I think some of the bigger pieces are being missed on how much is still sitting and floating. Now, we've had a lot of crude go into transit, so we should start to see that show up in both the U.S. and in Asia. So then when we look at land storage still remains on the positive side. So when you look at where we are in east of Suez, very normal for this time of year. This is the one where we look at floating to onshoring. So I think there's going to be that switch when you look at the amount that's offshore to the amount that's onshore. So you'll see this turn up. And then west of Suez still remains in a bullish backdrop. And a lot of that, especially when you look at the U.S. specifically, is driven by Pad 2. Pad 3 is still at the second highest ever, seasonally adjusted, obviously. But when you look at where it is, it's all in that Pad 2 component. And that is the bullish backdrop when you're looking at what is happening within land storage versus offshore. Then when we switch to offshore in terms of floating storage, when you look at west of Suez, we've actually flipped to a positive, to a negative when you're looking at surplus. So again, west of Suez continues to build when you look at West Africa, Europe, and the Gulf Coast. And then east of Suez had a little bit of a drop, but again, that's that timing delay that we've talked about. So we think east of Suez land we'll see an increase. East of Suez floating, we'll see a drop. And then the additional crude that has gone into motion in transit will then show up in here. One of the bigger pieces when we start looking at what is happening in general. So, and again, speaking to floating versus trying to play with their portfolio, the Korea National Oil Corp sold term supply of Abu Dhabi Murbain crude for all of 2022 at a premium of 10 to 13 cents to the grade's OSP. The buyer was China Oil. So KNOC will supply 300 to 350,000 barrels of Murbain grade per month for cargoes loading next year. So that's about 1/3 of the Murbain float. And it's essentially just Korea saying, look, we don't need this light sour, and then look for the buyer. So here it's obviously China. So this is for when you're looking at some of the shifts, it's going to be very important, because is Korea going to go out and buy something else? Have they stored up enough and they're starting to change some of their throughput? So again, this is just another, not so much bullish or bearish, just kind of a shifting tide in terms of where things are. And then when you look at China is keeping the same import quota for private oil refiners next year at 243 million metric tons, which is actually a fairly bearish backdrop, because there's actually more capacity coming online. So this is essentially forcing the smaller guys that are less efficient out of business, and is going to essentially shift and promote some of the mega facilities that have come on, with one of them increasing throughput through year end, and then in Q1 as they come online. So again, there's kind of that mix where it's really starting to focus on a different shift of the amount of teapots in operation. And then when we look at some of the adjustments so far, European imports of clean products from East Asia have continued to rise. The Rhine has reopened on the last leg, so that has helped through, as well as we've seen additional flow coming from the Middle East. Now, when we look at some of the different shifts in general as well, when we look at China and Asia in general, we're seeing them essentially move away from the refining, the crude slates within Europe and the U.S., and really going after that would be the east coast of Russia, as well as some of the Middle Eastern grades. Now, we've also had fuel retailers in China ration diesel and gasoline. They have started to lighten that up a bit. We've actually had an increase in storage off of the year low. Remember, when we look at what happened in China, China's now back to where they were pre-COVID, or really January, February of 2020. So you're starting to see some of this balancing, but they still have a ban on the amount of diesel they can export, essentially no exporting diesel right now, but they've lifted that on gasoline. So gasoline can now be exported again, which again is just more of that short-term issue. Now, when we turn to what's happening within the U.S., here's what we were talking about with the pace of increases starting to slow. So we still had that build of 3.29 million, but you can see that in 19 and then as well in 18, you had a fairly strong pivot higher, and we just didn't get that. So we're moving much closer to this 18 level, still seeing builds, but again, the pace of builds are an important backdrop. And then on the more bullish side, for those that were saying that we were going to see draws throughout the shoulder season, this is kind of the knock on it. But our view has always been that we were going to get normal builds. It was just going to be, the pace was going to be a bit slower. And then that also leads to what is happening in PADD 2 and Cushing. So then when we start looking at what are some of the shifts in general, China will ban the construction of refiners that have crude distillation units with smaller capacity than 10 million tons a year. So that was out last week, and we talked about that in the EIA show last week. It's just worth talking about once more, because that's why we're seeing them limit the amount of new quotas, keeping it the same versus 2021, because they just don't want to see that type of increase in general. So then when we look at what is happening in the days of supply for crude, so the days of supply for crude continue to go up. It's right in line. If we look at the 5-year average, obviously taking away 2020, we're right within that normal range. There's really nothing to say one way or the other. And the reason why we have that is because even though the pace of crude builds is fairly slow, or I should say the pace is not where it has been. The pace is also slow on the refining side. So again, this is a calculated number. So based on the refiners, we still have a fairly reduced level of operation. So that's why we're seeing some of these increases. Now, we expect to see PADD 3 increase, and as PADD 3 increases runs, that's again going to marry with the increase in imports that we've been talking about, but have so far been slow steaming into the region. Now, Middle Eastern oil products arrivals into Europe, continue to move up in October, and that's going to keep again, things kind of fairly flattish and really capped on what we're going to send from the Gulf of Mexico into Europe. Though it has increased, it's just not increased with where it normally does. So then when we look at crude and products, when we put it all together, as we were saying, we expected to kind of follow that 2019, 2018 pace, and we continue to be on that pace. We don't see that changing as we go through the first 2 weeks of November at this point. And we'll talk about what are some of the things that are happening, especially when we start looking at Thanksgiving and what's going to come next as we go through the remainder of this year. So October loading shipments of clean fuels from Asia to the Americas increased to 425,000 tons as of Monday, which is up from 320,000 tons. So we're just seeing that steady flow of what's coming from Asia into the Atlantic Basin. And again, it's going to be a marriage of, does it make sense to go into Europe at that moment, or does it make sense to kind of pivot and go into PADD 1 or the East Coast? And that's going to be a matter of who has the best pricing. Gasoline storage, again, the pace of decline slowed, still moving along the normal movement in terms of seasonality. Based on where we sit, this will probably look a little bit more like 2015. And the reason why is because gasoline demand has been, again, fairly stable, as we've been talking about. But we really haven't seen a big increase in gasoline production. And it's really because we're starting to see that increase in refinery run rates, but it's really honed in on that disti cut. And then the more we make diesel and heating oil, it'll start to throw off more gasoline. And that's when you start to see those increases in builds that again, we continue to expect to happen as we go forward. And then we look at distillate storage, here's that turn back higher, but again, still at a very low rate, still something where there's a lot of room to increase. And there's going to be a manage between kerosene and disti, because again, they can be pulled together. And that's going to be some of the manage of where you're going to get the best price, which is why right now it's going to still be in the distillate pool, which is, again, a big reason why we had that drop in jet and kerosene. But we're still fairly in line with the average. So there's nothing too crazy to say, because then if jet fuel gets better, they recover some of the kerosene that's in the disty pool, and you could separate it out. So that's something that they can manage and try to work with total flows. When we look at the crude curve, you can see it's pared back a bit from 2 weeks ago, as the whole curve shifted down in the really in the front end of it. It's still very strong when you look at we're above 75 essentially into 2022, and then 70 into essentially the end of 2022, and then above 65 straight through the end of 23. So still more than enough opportunity to pull forward some of that activity, as we've been talking about. The bigger issue is, and this is something that we've written extensively on, the bigger issue is going to be the availability of crews, the availability of equipment, labor, and those are conversations that have been happening for the last 2 months to bring some of this new capacity online. Because obviously, even if you hedge some of your exposure and let some of it float, there's still more than enough opportunity to see some of that those increases. Then when we look at the COVID net changes in general, as we look on the worldwide level, things are fairly stable. Nothing too much one way or the other. U.S. continues to be at a fairly flattish point in time. Europe coming down a little bit. UK coming back down a bit. On a positive side, Asia Pacific continues its natural trend, as Malaysia, Japan, India, and South Korea have maintained the trend. South Korea and Vietnam had a little bit of a spike, but again, none of this is going to be enough to derail the reopening and the fact that they've now been reopened for a little over a month. And as we get better at understanding this and treating this and disseminating vaccines, we're just not going to see any type of fear of a renewed lockdown. Though Singapore may be one to watch to see how they react, because we've seen a fairly big increase in cases there as well. Crude in the U.S., you had a build of 3.29 million. That's, when you look at it on an aggregate level, that's 53.2 million below the 5-year average. Pad 1 had a small build, still 4.5 million off the 5-year average, but again, it's all driven by Pad 2, with Pad 2 overall 32.4 million below the 5-year, and Cushing 26.8 million. So Pad 2 had a small increase of about 1 million barrels. Cushing had another draw of 920,000. That's something that we're going to talk about in a minute. And then when you look at Pad 3, had a build of 1.96. Again, that's 14.4 million above the 5-year average. As Pad 3, obviously with really the most storage. But again, there's that backdrop of low exports, higher imports, and fairly low refinery run rates versus Pad 2, where Pad 2 has imports that have still been fairly manageable and a big increase in refinery throughput. Then once we factor in the draws from the SPR, the build was only 1.64 million. Again, that's something that's going to continue overall. As we said last week, we expected to see an increase in production. So the production's back at 11.5 million. That's where we really should have been. Again, there's a lot of timing. This is a calculated number. And then if you factor in that there's still 150,000 barrels a day still offline, 150 to 170,000 barrels still offline in the Gulf of Mexico, that will be back by essentially the middle of November, so within the next 2 to 3 weeks, which puts us right at about 3.65, 3.7. And remember, our exit rate from March was 3.5 to 3.7. And we were expecting to be on the higher end of that range, so kind of right in line with where we believe that exit rate is going to be into Q1. Now, when we look at congestion, Google Mobility, just showing you kind of where we sit right now. Europe normalized a bit, but again, you had that kind of the seasonal spike. Now they're coming back down to, I think, a more manageable level going through the remainder of November into December. Where when we look at the Americas, starting to normalize a bit, that's really being driven by LATAM, that has seen a nice increase in activity. And then Apple Mobility, again, coming down and starting to normalize around this aggregated level. But then when we look at TomTom, Here you can see just kind of where the Google Mobility, TomTom really match up. China, now this is a bit lagged. So there's been a fairly sizable increase in cases in China, and they've increased restrictions. So we do expect that China to go from 103 to about 95 and probably settle at about 90 to 93, depending on the strictness that they're going to follow. It's already shown up in the flight data, which we'll talk about in a minute. But yet when you look at what has happened so far on the driving side, it still hasn't filtered all the way through, which again will come to pass. Now, when we look at pad 3, you can see that the pace of builds were just below where we were in 16. So it's really kind of that third highest it's ever been. But again, you kind of see where 2020, 2021, and 2016 really kind of merge, and we're expecting this to start to level off, but again, it's going to be a marriage of those imports with refinery run rates starting to ramp up, and they've been slow to do it. There was a hiccup in one of the facilities here as they were trying to turn back on the Shell facility. So again, you're still going to see kind of this battle back and forth, but we do expect to see refinery run rates increase in pad 3 that will pull through some additional imports. And that'll kind of flatline some of these builds that we've seen within this region. So then when we look at Cushing, here's where the pace of draws slowed, but you can still see that they've maintained their movement lower. Here we're coming into where we were for really this 2018, 2014 level. It's still going to, again, we're still going to see some of these movements. We expect this to kind of normalize a bit because it's going to become more important as we look at when does the front month contract when does that contract settle? And when that settles is when you're going to have to see some of this physical movement. Again, there's more contracts than there are physical contracts because a lot of them are financial, so they'll be sold before the expiry. So then it's a matter of how much of the expiry is left and how much either gets diverted away from pad 3 or how much can get reversed up from pad 3 into pad 2. So then when you look at Cushing overall, going back through just looking at the last 10 years, here you can see is that 2014 was the low. We breached that 2018 level, and now we're starting to flatline. Again, we're expecting this to not be as much where it was in 2011, where it kind of went sideways, but a bit more of a move up. Just, again, there's no real impetus at this point to see this big increase just based on what is available, what is there. It's just, I think, going to be the kind of that steadiness as the pace of the draws really start to slow down. But just based on what we're seeing so far, we expect the pace to remain. So we will see another draw. It just will be at that gradual side before it moves higher. Then when we look at runs, so runs, when you look at total crude, it was technically down 26,000 barrels, but on the utilization rate, it was up 1.2%. And again, it always matters about what is the process that is operating, because you may take less crude, but you're operating more equipment. So that's where you can get some of that deviation. So it was up 1.2%. We went from 85.1 to 86.3. Remember, we were expecting this to come closer to 87%. As we got into November, so here we are. There was some increases across the board, but again, Pad 5 had a fairly sizable decline of 157,000 barrels a day. We expect Pad 3 to be the biggest driver of increases as we go through the next 2 weeks. So then when we look at imports, you can see imports were down 82,000 barrels a day, still 832,000 barrels a day below the 5-year average. And most of that is still driven by Pad 3. Pad 3 is still 899,000 barrels a day below. But one of the things we were saying is that we expected to see a small increase, but still, about that 1.4 million. Instead, we had a small decline of 25,000, but again, still kind of within a fairly tight range. We expect that to see the bigger increase. And now we had an increase in imports into Pad 1 and Pad 2, but the drop was really driven by Pad 5 with a drop of 602,000 barrels a day. And just to be, when we're looking at what this looks like, how this is functioning, we've been saying that Pad 5 is going to be very lumpy. And that's just a perfect example right here, which we think will again, increase as we go through the remainder of, as we go into next week and the week after, we'll see that PAD 5 increase. And then weekly imports of diesel from Europe rose to the highest in 4 weeks. That's, again, something that's going to continue. We saw that total of about 1.1 million barrels. But then it's funny because now diesel's taking the headline because U.S. imports of gasoline for Europe rose over the last week to 1.34 million barrels. But again, which is about 191,000 barrels a day. Very much in line with what our expectations were. Implied demand, something that we were saying is that we expected to see a bounce in gasoline and disti. We did get that bounce in gasoline to 181,000 barrels a day to 9.5. We expect that again to move back down and then and again stay a little depressed over the next 2 weeks, but then again see that big rally as you go into Thanksgiving because you have to front load gasoline to make sure that everything is available for those that are going to travel, and then you have that refill because then people go fill up, they go drive, and then you have to have that backfill. And we'll look at the seasonality chart to really hone in on what that means. Disti had the drop of 183,000 barrels a day from 3.86 to 3.6. We were expecting a bounce to 4. So again, we just expect that bigger makeup. Jet fuel had a bounce, from to just over 1.6 to 1.68, where this will normalize closer to about 1.5. Again, just something that happens back and forth. And then propane, something similar. He had an increase of 302,000 barrels a day. More in line with what we were expecting on that, some of that bounce. So net, fairly stable with what we were expecting to see on a go forward basis. Now, when we look at the Gulf floating storage starting to tick higher, we expect this to continue to increase over the coming few weeks. And again, not going back to the 5-year average, but just essentially middle of this lower end of the cloud. Here's where you can see imports flatlining a bit. We were expecting this to go a little bit higher and essentially midway to that point that we had at the end of September. We just expect this to be that gradual move as we go up. Again, it's a bit lumpy, but when you average it out, that gradual move back to about 1.55 million barrels a day of imports. PAD 2 had that spike, closer to that high. We expect this to remain again over the 5-year average and start to make some of these seasonally adjusted highs as some of those imports increase. And then when you look at total utilization rate, when you look at the 5-year average, it's fairly in line. The 29-year average, it's starting to get closer. We just expect it to follow something very similar to what is that 29-year average in general and get closer to 87 and a half as we see about, I would say about 1% of that increase is going to be focused more on PAD 3 getting more active. And again, that'll marry with where those imports are in general. So now we've done that brief, or not brief, but fairly long overview. Now we can go a bit deeper into what's happening in PAD 2 and what does that mean for demand going forward.